Because today we're going to do trade and other debtors. You have come across some of trade and other debtors in those chapters that you had to do for preparation that week that you worked through chapters 1 to 8, and that was only an introduction into debtors. I want you to work through chapter 11 of my book, and you have to work through this chapter because it gives you much more information and good examples of what I'm trying to tell you about trade and other debtors. Good. What do we want to achieve in this learning, in this study unit? After the completion of the study unit, you should be able to apply the accounting treatment of debtors. You have to know when an asset is classified as a current asset, and you have to understand, calculate, and disclose credit losses and allowance for credit losses. Guys, ACCC is financial accounting, and financial accounting is all about disclosure. Disclosure that has been prescribed by the International Accounting Financial Reporting Standards. So, you cannot disclose something the way that you think it should be disclosed. You cannot disclose something in the way that you want to disclose it. This is all prescribed, and you have to follow the rules and regulations of the IFRS statements. Okay, this oak came home and he asked his dad, Dad, what is the difference between a debtor and a creditor? So ask yourself the question, what is the difference between a debtor and a creditor? And he's got a very wise man for a dad. And his dad sat down and he explained to him the difference as follows. A debtor is a man who owes money, and a creditor is the man who thinks he's going to get that money. So just ponder over that one for a little while to understand the difference between a debtor and a creditor. Guys, just to put you in the picture, where are we and where are we going to? We are talking about the statement of financial position, and that is the way that we disclose that. The name of the entity, statement of financial position as of 31 December, comparative figures, rand denomination, and the note. And under assets, we have non-current assets and we have current assets. And under current assets, we have inventory, trade and other receivables, cash and cash equivalents, and then total assets. Now, in study unit 4, we have done cash and cash equivalents. In study unit 5, we are going to do trade and other receivables. Now, it is very important that you can distinguish between a non-current asset and a current asset. Now, when we've done the conceptual framework, we have done the definition and recognition criteria of an asset. Now, I can expand that question and I can ask you, number one, define whether it's a current asset or what is the element. And once you have actually identified the element as an asset, I can ask you to define and write for me, and then with theory behind it, then actually justify whether this asset is a current asset or a non-current asset. So therefore you have to know these criteria because it can be an additional question to the conceptual framework. Now, when is an asset a current asset? If it is expected to be realized in, or if it's intended for sale or consumption in the entity's normal operating cycle. Now let's just stop there for a little while. What does the word realize means? Realize means I'm going to get rid of it. I'm going to sell it. So if it's expected to be sold, or it is intended that that item must be sold. If I have bought an inventory item, my intention is for sure that I want to sell that. So inventory will be a current asset because it was intended for selling purposes. Or if I have the intention to consume something within the entity's normal operating cycle. Now, what is a normal operating cycle? Guys, now normally a normal operating cycle should be less than 12 months. Now, there are entities whose normal operating cycle is longer than 12 months. Just think about a big construction business. If I get a contract to erect a building let's say a 10-story building, and I have to do everything. It is very possible that it's going to take me longer than 12 months to finish off that building. So if that is my business to build these kind of buildings, then it means that my normal operating cycle will be a longer than 12-month cycle. But I think it's fair to say that 99.9% of all kinds of businesses have a normal operating cycle which is not longer than 12 months. Now, the second thing is a current asset also have to satisfy the criteria that it is held primarily for the purpose of being traded. Now, if you think again, inventory, what is the purpose of inventory? The purpose of inventory is to trade the inventory so that I can make money, so that I can buy more, so that I can make more money, so that I can make more money, and I can make profits. So the purpose is for trading purposes. If you think about a debtor, how does a debtor come about? It is when I sell some of my inventory on credit to a third party. So it was initiated or originated by a trading transaction where I've actually traded my inventory, and in return for that inventory that I gave this guy, he owes me the money. He has to pay me back the amount of that inventory that I've given to him. The third criteria that a current asset is, it is expected to be realized within 12 months after the end of the reporting period. Now here we actually assume that the normal operating cycle is 12 months or less. So that current asset must be realized, so it must be converted into cash in a period which is within 12 months after the reporting period. The next criteria is it can be a cash or cash equivalent, because then it's already cash. So it's either have to be converted into cash within 12 months, or it must already be cash, and then it is a current asset. Well, this guy, he was not so clever. He consolidated all his debt into a 10-year sentence. Now, I would not suggest or recommend that you do that. Okay, now what does current assets consist of then? It will be then inventory, the one that we are going to do today, trade and other debtors, and cash equivalents. This guy also doesn't give very good advice. He says, I'm not so much of a hunter or a gatherer, I'm much more of a borrower. Now, this kind of attitude can definitely lead to the previous kind of thing, that he's going to convert all his debt into a 10-year sentence. Now, guys, we say each and every entity have to decide, are we going to sell our merchandise on credit or not? And if the answer is yes, we will allow some people to make a credit purchase from us. Then we must have a credit policy in place. Now, the first thing with a credit policy is that we have to decide how much credit are we going to give to debtors, and to what debtors are we going to extend any credit, and to what debtors are we not going to extend any credit at all. Now, what will determine this decision of us whether we're going to extend credit to somebody or not? Number one, it will be based on his ability to repay that money that he owes us. That is the most important and foremost thing that I'm going to evaluate. Will this guy be able to settle this outstanding debt within a reasonable time? So I also have to decide, what is the period that I'm going to extend the credit for? Is it going to be 6 months? Am I going to allow it to pay his outstanding debt over 6 months? Is it going to be 12 months? Is it going to be 3 years? What is going to be my credit term where I'm going to expect from this guy to repay me? Now, when I'm going to decide whether I'm going to extend credit to you or not, I obviously would like some financial information from you. If you are an individual like you and me, they probably would like to see a pay slip. So they want to see how much money do you earn, what are your expenses, and do you have still enough money left after you've paid all your necessary expenses to repay any debt. And if they look at that and evaluate your financial position, they will then decide whether they're going to give you credit or not. If it is credit that they're going to extend to an entity, they would like to see the financial statements of the entity to see whether this entity has a good reputation of repaying debt in the past, whether their cash flow position is as such that they can easily afford to repay the outstanding debt, and what does it look like? Do they make profits? Are they going to be in existence in the near future? Because if they're going to be bankrupt, obviously I'm not going to get my money back. And then based on that risk profile of the guy who wants the credit from us, we will then decide what is the credit term that we are able to extend to him. Now, obviously, guys, the quicker that this entity can get his money from the debtors, the better for the entity itself, because that will then improve his own cash position, which will enable him to go and buy more stock, which he can sell so that he can make more profit. So he wants to encourage his debtors to pay off their outstanding debt as quickly as possible. So he might decide to give a little incentive to his debtors to make them settle their outstanding accounts within a shorter period of time what they initially thought they're going to repay the debt. So therefore, he can tell his debtors, look, man, if you're going to repay this outstanding invoice within 15 days after the invoice date, I will give you a 5% settlement discount. So the invoice is fixed. I cannot alter the amount of the invoice. He owes me 100 Rand. If he's going to pay me within 15 days, he doesn't have to pay me 100 Rand. He can only pay me 95 Rand, and I will be okay with that. He says, but if you're going to pay me within 30 days, I'm still lenient, and I will give you a 2% discount. So if you're going to pay me within 30 days, you don't have to repay me 100 Rand. You only have to give me 98 Rand, and I will be happy with that. So obviously, any settlement discounts must form part of the credit policy of the entity. And that settlement terms should appear on the face of the invoice that you're going to give your debtor once you do a credit sale. So at the end of the day, the settlement discount then will have the effect that the guy is not going to settle the full outstanding amount. Now let's assume that we have accounted for a sales transaction of 100 Rand. So we're going to debit the debtors account with 100 Rand. We're going to credit sales with 100 Rand. Now the guy pays us within 15 days and he only gives us 95 Rand. So we receive 95 Rand in our bank account, debit bank, and we're going to credit our debtors account with the amount received of 95 Rand. Will we ever receive the other 5 Rand? Never ever, because we've said to this guy, it's okay. If you're going to pay us within 15 days, you only have to give me 95 Rand and we will forget about the rest. But we have to adjust this account to show a zero outstanding balance. So we obviously want to credit this account with the other 5 Rand. And now's the question, what should we debit? Now, when you were at school, the teacher told you to debit a settlement discount or discount granted expense account. Now I'm telling you, if you're going to use a settlement discount granted or a settlement discount or a discount granted account or a discount received account, you will get straight away minus 5% on your paper, straight away. Listen what happened in this transaction. Initially, we said debit debtors 100 Rand, credit sales 100 Rand. What was the actual sales proceeds on this item that we have sold to the debtor? Have we received 100 Rand for that item that we sell? No, we only received 95 Rand. So whenever we're going to adjust the debtors account with the other 5 Rand, we're not going to pass a debit entry to an expense account. We are going to rectify the sales amount in our books. So that 5 Rand will be debited against the sales account. At what value is sales now in our books after that adjustment entry? At 95 Rand. How much money did we receive for that item that we've sold? 95 Rand. Isn't my sales account correct now? Yes, because it's a reflection of the actual proceeds when I've sold that item of merchandise. So settlement discounts granted will be adjusted against my sales account in my statement of profit or loss. What about interest? What is interest? Now I have told the guy, look, I give you 5% settlement discount if you repay the invoice within 15 days. I will give you 2% settlement discount if you repay your invoice within 30 days. If you still haven't paid your invoice after 60 days, I am going to levy interest on your account. This is because by now our initial policy was that you have to pay me within 45 days. That was the maximum. I actually was lenient. I allowed you not to repay me up to 60 days, but from the day 60 onwards, you will have to pay, let's say, prime plus 2% interest on your outstanding balance. Now, when I sell merchandise on credit to somebody, what do I in effect do? I grant him finance. I tell him, listen, guy, I will finance this transaction for a period of, let's say, 45 days. So my credit term is 45 days. If you're going to pay within 30 days, you will get certain settlement discounts. From 30 to 45 days, I will still be lenient, but 45 days, that is my cutoff date. If you still haven't paid me within 60 days, I'm going to levy interest on your account. So that means that my credit term is actually 45 days. If you don't want to stick with my credit term, it means I have to start asking you financing costs. It's nothing to do with the sales transaction that took place. It's now everything to do with this amount of credit that I've extended to you and you haven't paid within the prescribed period. And therefore I have to penalize you, but the penalizing has got to do with the finance that I've extended to you. Therefore, I cannot adjust my sales account. It's got absolutely nothing to do with the sales transaction that took place. This levying of interest has 100% to do with the fact that I've extended credit to you for a period of 45 days. And from the 60th day, I'm going to start penalizing you because you still haven't paid your outstanding debt. So therefore, if I'm going to levy interest on the outstanding debtors account, I'm going to debit the debtors account because it needs to increase with the interest amount, and I'm going to credit an interest income account. And that income account obviously is going to go to my statement of profit or loss. Now, in my accounting records, it is very important that you know that you have a debtors ledger. Somewhere in one of those chapters that you've done on my book, when we did that week, all my book chapters, you have seen that I have a debtors ledger. You always also know that in the debtors ledger, for each and every guy that I sell anything on credit on, he's got his own account in the debtors ledger. In each and every debtor A, B, C, D, whatever his name is, all transactions that I've done with this guy will be recorded in his own account. So all the sales, credit sales that I've made from me will be posted from the debtors journal or the sales journal into his account. All the returns or rebates that he has received, that will be posted to his account from the debtors allowances journal. All cash received from him will be posted from the cash book receipts journal. So the detail of all the transactions done with a specific debtor will appear in his debtors, individual debtors account. And this account is being updated right through the month as and when a transaction takes place. What happens at the end of the month? At the end of the month, I'm going to get all my debtors, I'm going to list them all, A, B, C, D, E, F, G, whatever, all the names of the debtors, and next to them, I'm going to state all their outstanding balances as at month end, and that is what we call a debtors list. We're going to add up all these outstanding balances, and that is going to be our total outstanding amount as per the debtors list. Now, what do we post to the general ledger? What goes to our debtors control account? Now, our debtors control account in the general ledger, we've said, is just a summary of everything that happened right through the month in our subsidiary journals. So what do we post to the debtors control account? Well, we will post the total of the debtors column in the debtors journal to the debtors control account. The total of the debtors column in the debtors allowance account, that will go to the debtors control account. The total of the debtors column in the cash book receipts journal, that would be posted to the debtors control account. Only totals, so no detail. If I want detail, I have to go to the subsidiary ledger and to the individual debtors account in the debtors ledger. When we actually going to then a balance of our debtors control account at the end of the financial month, and we're going to get a balance of our debtors control account, that balance must reconcile to the total of the debtors list. It's the same transactions. The only difference is here are the detailed transactions posted individually in each and every account during the course of the month, and here we only post totals to the debtors control account. Same transactions, only totals there and detail there. And therefore, at the end of the month, that balances must be exactly the same. And if they are not the same, I have to find out why and have to make correction entries wherever needed. So at the end of the day, after I had to do correction entries, it must exactly be the same balance. Now, what happens with debtors with creditors balances? Look at this one. Creditors have much more better memories than debtors, and that's a fact of life. Now, guys, according to IFRS and IAS, once a debtor has a credit balance, what does it mean if you think about that? It means that that debtor no longer owes the entity any money because it's a credit balance now. What does that mean? It means that the entity owes the debtor now some money. So if that is the case, those debtors with credit balances should be shown as creditors in the statement of financial position. So I will remove their balance out of the debtors book and I will transfer it to a creditors account in the creditors ledger. And that is being prescribed by IS1. Great stuff. Now, what is credit losses? At school, they taught you about bad debts. I don't talk about bad debts anymore, but it's exactly the same thing. You should not talk about bad debts either because you will be penalized if you do. The new word that you have to learn is credit losses. When do we write off credit losses? Now, that is when a debtor's account is totally irrecoverable. There is no ways I'm going to get that money from that debtor. For some other reason, he's unable to settle his account. He could have disappeared from the face of the earth. I haven't got a clue what happened to this guy. I'm unable to trace him. I don't know what happened to him. Or alternatively, he could have been sequestrated. He could have been insolvent, so he's not able to settle his outstanding debt. Whatever the reason is, I have now discovered that I will never ever recover his outstanding debt. Now, have I sold something to this guy? Yes, initially I debited the debtor's account, credit sales. Now it's a year further on. I've already recognized the sales revenue. IFRS now says you are not going to fiddle around with your sales. You're going to leave your sales amount as is. If you're going to write off this outstanding debt, you're going to create a new account, which is an expense account, and we call that account credit losses. Credit losses written off, credit losses, an expense account. So you're going to credit a debtors account, let's say with 1,000 Rand, you're going to debit an expense account with 1,000 Rand. Let's do an example. Jeff Skilling is a debtor of Pick Traders and he owns 10,000 Rand. However, Jeff Skilling has been sequestrated and his estate pays only 5 cents in the Rand of his outstanding debt. So how much are we going to receive? We're going to receive 5 cents, 5% then of 10,000 Rand, which equals 500 Rand. That is what we're going to receive. How much is still left on his account? 9,500 Rand. What are we going to do with the 9,500 Rand? We're going to write it off as a credit loss. So we're going to debit bank with the amount we're going to receive, the 500 Rand. We're going to credit debtors with 500 Rand. Then we're going to create an expense account, credit losses, 9,500 Rand, and we're going to credit debtors, 9,500 Rand. Now, what is the difference between when I know that I'm not going to recover a debt and when I expect that I'm never going to recover a debt? When I know I'm not going to recover a debt, I'm going to write it off as credit losses, the one that we've just seen here. So we have written it off. That debtors does not exist in our books anymore. There's a debit of 500, a credit of 500 Rand. Here's a credit of 9,500 Rand. So we've totally eliminated that debtor out of our books. In this case, I've heard a lot of rumors. I know that this entity owes me money. Is in the process of, let's say, retrenching their staff members, or that they've lost huge contracts and that their cash flow position is suspect. Or I know somebody else who also extended credit to these guys, and now they have battled now for already 18 months to get their outstanding debt collected from this specific debtor. So it's not 100% sure that I'm not going to collect my debt, but all the signs are there that most probably I am not going to collect my debt or a portion of the outstanding debt. Now, in a case like that, we are going to create an allowance for credit losses. So when there's an expectation, it's not for sure, but there's all indications, there's the expectation that the debtor is not able to settle his debt, I'm going to create this allowance for settlement discount. For credit losses, allowance for credit losses. How am I going to do that? Now, let's say this guy owes us 10,000 Rand. So what I'm going to do is, I don't want to write off his outstanding debt. Why not, guys? Because as soon as I write off his debt, he disappears from the screen. And I'm not going to phone him now 5,000 times per day and say, where's my money, where's my money, where's my money? I'm going to forget to do that because he doesn't appear on my screen anymore. So I want to keep him on my screen. I very much would like to keep him active, and I would very much like to collect my debt from him. So I'm going to create something else on the sideline which is not visible to him. And I'm going to create this allowance account. So how I'm going to do that? I'm going to debit an expense account, credit losses, and I'm going to credit an allowance for credit losses account, 10,000 Rand. So my gross debtors is still going to show 10,000 Rand, the outstanding debt. But then for financial statement purposes, I'm going to say less allowance for credit losses, 10,000 Rand, net debtors, 0. So the amount that's going to go to my statement of financial position is going to be 0. I have to disclose both. I have to disclose both the gross amount, 10,000, as well as the allowance for credit losses of 10,000. But the net amount is going to be 0. And that is what is going to be the value of my current asset in the statement of financial position, 0. So I've got an expectation, a serious expectation this guy is not going to pay his outstanding debt. But I don't remove him out of my books. I just create an allowance for credit losses. I will debit an expense account credit losses, each expense. I'm going to create an allowance for credit losses, a negative asset account. Why a negative asset? What does this allowance for credit losses effectively do? It reduces my outstanding debtors amount. So what is debtors? It is an asset. So this is a negative asset. It's not a liability. I don't owe any person any money. It just reduces my asset to what? To an amount that will ensure that whatever I'm going to disclose as debtors is going to be a reliable amount. It's going to be an amount which is reflective of a faithful representation of my assets in my statement of financial position. So it is set off against debtors in the financial statement of financial position. Now, I want you to go to your textbook and work through the examples. Whenever I'm going to write off this debt that I expected is going to go belly up, sometime after I've created the allowance for credit losses, I now have a choice. I can either write off the actual credit loss against the allowance account, therefore I'm going to debit credit losses expense, I'll debit my allowance account and credit my debtors account. Debit my allowance account and credit my debtors account. Or alternatively, I can keep my allowance for credit losses account as is. So if I'm going to write off that debt now, finally, going to credit debtors, debit my expense account with that outstanding debtors amount of 10,000. Then what I'm going to do at the end of the financial year, I'm going to adjust my allowance for credit losses account to be reflective of my expectation on outstanding debtors as at the end of the financial year. Now, if I've been in business for quite some time, I can gather statistics and I can know that, let's say, over a 10-year period that I've actually looked at the collection of outstanding debt, I have found that on average, I only collect 95% of outstanding debtors on an annual basis. So it is then safe to say and to assume that whatever my outstanding debtors amount is at the end of the year, I will only collect 95% of that outstanding debt in the next financial year. So what am I going to do then? If I'm then going to create an allowance for credit losses, I will say, well, on my outstanding debt at the end of the year, I'm going to take that amount, multiply it by 5%, and that is the allowance for credit losses that I want in my books at the end of the year. Now, if I'm only going to adjust this account on an annual basis at the end of the year, what am I going to do? If I had an allowance for credit losses of 1,000 Rand at the end of the previous financial year, and I want 1,500 Rand at the end of this year, obviously I'm only going to post the movement in the balance in the current year. So it is a credit balance, the allowance for credit losses. I want to increase that credit balance from 1,000 to 1,500. So I have to credit the allowance account with 500 Rand. What is the counter leg of that entry? The counter leg of that entry is going to be credit losses expense account. Now only with a movement of 500 Rand. So in my expenses, I'm going to show 500 Rand. What is going to be shown in my statement of financial position? The full amount of 1,500 Rand, i.e. the balance at the end of the year on the allowance for credit losses account. Good. Now, I've said you're going to debit an expense account, whether you're going to debit the credit losses account or whether you're going to debit an allowance for credit losses adjustment account. I am not tense about that. You can also use that. What is important to me is that you know that you have to debit whatever the movement is to an expense account. What if the allowance now works out less than last year's balance? So last year I had 1,000 Rand allowance for credit losses. Now I worked out everything and now I only need 800 Rand. So then I need a debit on my allowance account, and then I will credit either credit losses account, which is then a credit against an expense account, or I'm going to credit my adjustment for allowance for credit losses account with that 200 Rand difference between the 1,000 and the 800, which I want at the end of the year. So part of my income statement will be 200 Rand credit. So it's an income in my income statement. And in my statement of financial position, I will have allowance for credit losses, which is going to be deducted from my outstanding debtors, equal to 800 Rand. Now, what about VAT? What is our good friend VAT all about? And how does VAT impact credit losses and allowance for credit losses? Let's take the first one first, credit losses. Initially, when I recorded the sales transaction, I said debit the debtors with the invoice amount, credit sales with the VAT exclusive amount, and credit VAT output with the VAT amount appearing on the invoice. Now, after some time has expired, I've realized I'm never going to collect that debt. The receiver of revenue says, look, I know that you've already paid over the VAT output on this transaction. I also recognize that you've never collected that money. So now if you're going to write off the debt, you can claim the VAT on the credit losses again. So let's assume that the debtor has an outstanding balance of 10,000 Rand. The VAT exclusive amount, i.e. divided by 1.15, equals 8696. So I will credit the debtors account with 8696 and debit credit losses expense account 8696. Then I'm going to claim the VAT. So I will debit my VAT input account with 1304 and credit debtors with 1304. So in total, I've written off 10,000 Rand from my debtors account, but only the VAT exclusive amount will go as an expense account, and I can claim the VAT portion back from the receiver of revenue as VAT input. Now that also then confirms what we originally said. Never ever in our income statement will any income or expense account include VAT. So there clearly our credit losses excludes VAT. However, this doesn't work the same with the allowance account. The receiver of revenue says you can claim VAT on this amount at the date that that this debt actually went belly up. He says, I'm not interested about your expectations. I'm not interested about your gut feel. The day that debt actually turns sour and you have to write it off as not collectible, that day you can claim VAT from me. He says, so if you create an allowance, it's got absolutely nothing to do with me. So there's no VAT input and VAT output on the allowance. But now think carefully. The guy owes me 10,000 Rand. I don't expect to collect that 10,000 Rand from him. Let's say that my expectation actually comes through. How much of that outstanding debt of 10,000 Rand is going to be written off out of my own pocket? What is going to be my part of that loss? Only the VAT exclusive part, because whenever I'm going to write off this debt in actual life, in real life, I can claim back the VAT. So how much is going to come out of my back pocket? Only the 8696, only the VAT exclusive part. So therefore he says, whenever you're going to create an allowance for credit losses, you are going to remove the VAT out of your outstanding debtors amount. And then you're going to apply the percentage of the allowance for credit losses that you want. So let's say that my expectation is that 10,000 Rand of debtors is going to go belly up. So I want to create an allowance for 10,000 Rand of outstanding debt. So what am I going to do? I'm going to take the 10,000, I'm going to divide it by 1.15, which gives me 8696. And then I'm going to say debit credit losses or credit losses adjustment account 8696, credit allowance for credit losses only with 8696, the VAT exclusive amount. If I'm going to apply a certain percentage on my outstanding debtors on an annual basis, I will say, okay, my total outstanding debt is, argument's sake, 50,000 Rand. I have seen that over the last 10 years, 5% of outstanding debt is not collectible. So I'm going to take my outstanding debt of 50,000, I'm going to multiply it by 5%, and that gives me 2,500, and then I'm going to take out the VAT, divided by 1.15. So the amount that I'm going to create as an allowance for credit losses is going to be 2174. That is then the 50,000 times 5% divided by 1.15. That gives me the amount. Debit credit losses 2174, credit allowance for credit losses 2174. Let's look at presentation and disclosure, because that is extremely important. On the face of my statement of financial position, guys, and you have the name of the entity, the statement, the date, the note, reference, and the rand denomination. Under current assets, you will see trade and other receivables. Look at the wording, trade and other receivables. So it's not only trade receivables, not only debtors, it's other receivables as well. Note number 7, the total 49,000. And if I go to that note, again, proper heading, ABC Traders here, notes to the financial statements for the year ended 29 February 2012. Note number 7, trade and other debtors. Trade debtors was 50,000. The allowance for credit losses, 3,000 minus 3,000. And now my other debtors. That is my trade debtors. I could have inserted here another line. I actually like to insert another line here. Net trade debtors 47,000. And then I'm going to add all the other stuff. Accrued income 1,500 Rand. Prepaid expenses 500 Rand. In total 49,000. And then that total balances back to this total here. Only one line item on the face of my statement of financial position. 49,000 Rand the total there. Okay, and then we will do the class question in a next